You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Well, Hamish, what a week in the markets. Well. Here we go again. Man, who knows what to think right now. One day the market's up 3%, the next day it's down 3%. Certainly very volatile.
It's crazy. Yeah. Did you see what happened with Robinhood on Monday? Not good.
No. What happened with Robinhood?
Yeah, so Robinhood on Monday. So we had last week, obviously, which was very negative, and then Monday was very positive, but unfortunately it wasn't very positive for people using Robinhood because it decided not to open
for
the entire trading day for the US market on Monday, which is real bad. Yeah.
Actually, I did hear about this, and I think the users are trying to gang up and sue them, right?
Yeah, I think there is something forming. I don't think there's anything official yet. But I believe that's probably going to be the case because it was such a big day. I think the Dow was up maybe 3.5% or 4% or something like that, which is,
Man, imagine if you just were trying to buy or sell something and then you just couldn't because your broker was just out of action on that day.
Yeah.
That's so bad.
Yeah.
Although you probably keep digging down into their terms and conditions and they'll probably be like, you signed up for this.
Yeah. It's always interesting. I mean, those new brokers, I think they're fantastic because you get free brokerage and it's a great opportunity for a lot of people to get into the market. But yeah, there's definitely things that sort of tend to go wrong from time to time with these newer brokers who haven't been established for a very long time, such as compared to a bank that's been around for 100 years, for example. But
and the thing with these brokers is that because they're so cheap, they're all completely digital. So it's either and they're basically all app based. So a lot of them don't even have a website. They'll just be the app. So if the app goes down, then that's it. Whereas if you were trading through CommSec, the app went down, you could still log on to their website, or if worst comes to worst, you could probably just march on into one of the CommSec branches and say, hey, I want to buy these shares right now.
Yeah, that's it.
And they'll probably help you out.
Exactly. Yeah, that's so true. Before we get into it, we've got a ton of stuff to talk about the markets and a couple of different companies, some interesting things happening. But before we do that, we should probably have a word from our sponsor. So this episode is sponsored by Sharesight. So Sharesight is an application that I've personally been using for over the past few years to track the performance of my stock portfolio. And it is just fantastic for keeping track of your capital gains, your dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains, if you are buying shares internationally or you hold foreign currencies. And then the main reason why I use it is when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to easily work out things such as your capital gains, your dividend income, and other things. And you can try Sharesight for free by heading over to sharesight.com/young investors. And that is site spelled SIGHT, sharesight.com/young investors. And if you use that link, you can also get 2 months free when you sign up for a yearly subscription.
I really need to make an account. Actually, that's going to be my job for today, is make a Sharesight account, because I know you've been talking to me about this for months and months and months. At least that's what I can remember. Just being like, dude, this website, you need to get on this because it's so good for tracking everything. And I hear, I get comments all the time. Hey, do you use Sharesight? I'm gonna do it right now in the background. And I'm gonna sign up.
And they have a completely free plan. So if you want to just go check it out, you can just try it for as long as you want for free. And there's a limit on how many stocks you can have in your portfolio when you do that, and limited number of trades and that sort of thing. But you can basically go and try it for free. There's no cost. And then, as I mentioned, if you want 2 months free, then use our link. And
right, so I haven't actually looked at this yet. So we go to our link, and then we've got like our own dedicated kind of landing page thing. And then, so what'd you say? We get 2 months for free.
Yeah, so if you sign up for a yearly subscription, you get 2 months free. Yeah,
cool. Well, I may as well use Can I use our own link?
Yeah, I guess you can.
I guess is that dodgy? I don't know.
No, I think that's allowed.
Anyway, but no, thank you to Sharesight for sponsoring, and I'm very keen to actually get in and have a look at the platform myself. Hopefully, it's good. Everyone that I talk to or hear from says it's good. So yeah, we'll have to wait and see.
We will.
Anyway, all right, let's move right along. What should we talk about next?
Yeah, well, I mean, just to stay in talking about the markets this week and last week just for a little bit longer. So last week we saw that it was very negative last week. There was a lot of fear. I think the market was down about 11% last week, or 10% or something like that. And then this week, I think I just noticed that over the past 5 days, it has actually been positive, mildly positive. So it has sort of recovered a little bit. This week's been a little bit up, down.
Yeah, it's been very volatile.
Yeah, and I just sort of went back over the past few years to kind of see what has been the big dips in the market over the past couple of years. So last year we had 2 different times where the market went down 5 or 6%, but that was about it, and then it was just roaring on. We had the year where what was the return for the US market? Something like 28% or 30% or something insane.
Yeah.
And then I went back and had a look in 2018 to see what that drop was like, and that one towards the end of the year was 17%. So we're not quite to that drop.
We're not at that level.
No. And considering this drop is falling from a higher price as well, the percentage means that the drop is bigger in terms of points, but it's not as dramatic as the market certainly isn't as low as it was at the end of 2018.
I'm trying to think back to that drop in 2018, the big 17%. Do you remember, was there anything that triggered that? Was it trade war stuff? I can't even remember now looking back.
Yeah, I believe there was a couple of things going on. At the start of that year was when the tariffs really started to sort of pick up, and then they continued into September. But I believe the triggering event was that the Federal Reserve tried to raise interest rates. So I believe they tried to raise interest rates once or something, and everyone just panicked. And I mean, I guess we can speak of interest rates as well, because we have interest rate news this week as well from the Australian and the US market.
Yeah. Should we talk about that? So first of all, I guess we'll talk about what happened in the States. So the Fed came out and they announced a 0.5% emergency rate cut, which I don't know why would you use the word emergency?
Yeah, well,
why wouldn't you just say it's a 0.5% rate cut to help the economy get through the coronavirus scare or something?
Yeah,
you have to say emergency rate cut, or maybe that was just something the media did. I don't know. Actually,
I think it's the definition of the type of cut, but it's a terrible name because typically they meet every single month and they decide whether they're going to cut, raise, or leave it the same. And if they do it out of turn, in the middle of the month, it's called an emergency rate cut. But the last time that they did that was during the GFC, or just prior to the GFC. So, during the GFC, I should say. So it is something they haven't done in a very long time, but it's a shocking name, and it really doesn't instill any confidence, does it? It kind of makes you think, if this is the first time they've done this in 10 years, and it's a decent rate cut. It's not the standard 0.25, which is usually what the Federal Reserves do when they're doing a rate cut or a rate rise. 0.5 is substantial. It's a big jump.
Yeah. So, you'd expect that if the Fed or if the RBA or whatever central bank cuts interest rates, you'd expect that the market would do pretty well in the day after, right?
Yeah, so I mean, typically, when it comes to particularly the US, the US rates, we kind of use that as a benchmark as the risk-free alternative because it's kind of the globally accepted safest investment alternative. So whenever that's going down, it makes other riskier asset classes like stocks more attractive, which means people want to buy more of them. But I was having sort of related to the official interest rate drop is the 10-year treasury yield, which is the actual risk-free investment that we can make in the US. That dropped to its lowest ever in history, which was 0.92. So in other words, there's really not much further than that rate can go before it goes negative, which of course it's never been negative in US history because this is the lowest it's been. And it's at 0.9. It's still positive. So
right. So that's an annual return.
It is, yes. It's an annual return.
0.92%.
And you lock your money away for a 10-year period.
For 10 years. Holy smokes. Who's buying that?
Well, the Fed, basically. So whenever the Fed wants to lower interest rates, they buy US Treasury bonds. And as a result, that lowers that rate. But yeah, it just makes everything else look so attractive, if the alternative is 0.92%, then you might be happy with a 3% return out of stocks, which is paying 30 times earnings on a company that's not growing, which it seems insane. So
we were talking about that last week, weren't we?
Yeah, we were talking about that. Warren Buffett was talking about how the relationship between really low interest rates works with businesses, and if interest rates are really low, then people are willing to pay a high price for businesses, even though they're risky, because they offer a better return.
Yeah, so the Fed announced this 0.5% emergency rate cut. The market you would anticipate the market to go up, but it actually went down by 3%.
Yeah, that's not good.
That's the thing that was a little bit out of place, is that they made this big emergency rate cut and then the market dropped. And then we can have a look at what happened here in Australia as well, is that the RBA slashed its interest rates now from 0.75% to a fresh record low of 0.5%. Wow. And the anecdote here, the RBA has now cut interest rates 4 times within the past year. Wow. And they note that coronavirus could wipe anywhere from 0.3 to 7.9%. How's that for a range?
I know. They have no idea.
0.3 to 7.9% from Australian GDP, depending on the outbreak severity.
Yeah.
Analysts warn. To me, that just says analysts have got no idea how big of an impact this is going.
We have no idea. It might have no impact, or it might send Australia into the worst recession we've ever seen. It's basically what that says.
Oh, that's quality.
Yeah.
Oh, man. That's so funny. 0.3 to 7.9%. What have you written here? Australian dollar strengthened a little bit.
Yes. So the Aussie dollar moved after the move that the Fed did in the US, dropping their rates. That makes the Aussie dollar look a little bit better against the US dollar. So we spoke about it, how the relationship between the Aussie dollar and the US dollar was down to 65 US cents per Australian dollar last week. This week it's risen all the way up to 66 cents. Wow.
Oh, yeah.
Huge increase. But
so much better. Gosh, I'm going to book my US holiday right now.
Yeah, so not much better, but that's kind of how that works. If the US drops their interest rates, then the way you should think about it is where are people willing to put their money and to earn interest in savings accounts, basically, is sort of the easy way to think about it. If the Fed drops their rates, their savings accounts or their deposit accounts offer lower rates, so it makes the Australian dollar relatively look more attractive.
Okay.
So yeah, but not much of a move because the Australian Reserve, the Reserve Bank of Australia, also dropped their rates. So it's can't expect too much of a change there.
Yeah, that's crazy. There's certainly a lot of craziness going on with everything at the moment. Just so much fear and panic with this whole coronavirus scare. I mean, I just don't understand. Like, you even see it in the shops at the moment. There's like this whole thing. I thought this was a joke, but it's not. And like, I went to the shops yesterday and I walked through the toilet paper aisle and there's no toilet paper there. It's just been bought out. Why do people think that coronavirus is like gastro or something? Do they think that they're going to need like 5 years worth of toilet paper in the next 3 months? I don't know.
That's fascinating to me because I think this is what's happened. Somehow the news has got onto the idea that people are buying a lot of toilet paper. And then as soon as it's on the news, everyone's like, oh, wait, I only have one I only have a bit of toilet paper left. And if there's none available, it's not even related to coronavirus. It's just that I need to buy toilet paper, but I wasn't thinking that the bloody stores were going to run out of it. So now everyone's just running. And I was at the shops yesterday and I saw multiple people with full trolley loads of toilet paper.
Why?
And it just makes no sense.
It doesn't make sense. It's like the flu. But like, why aren't tissues being sold out? Maybe they are. I don't know. But it's not like the coronavirus diarrhea virus. It's just crazy. Like toilet paper's, it's gone. Bottled water is another one that's being that people are grabbing.
And bottled water makes a little bit more sense because if people are thinking that there's going to be a lockdown and you can't go in public places and that sort of thing, bottled water makes more sense.
Or a contamination of the water supply. Or
contamination,
like that. That does make a little bit more sense, but I mean, I always knew that there'd be panic in the stock market to some extent, but I never thought that I'd see panic just like in day-to-day life.
Yeah.
I mean, there's not even that many confirmed cases in Australia, yet all the supermarkets around Australia are being sold out of toilet paper and bottled water. It's just...
Yeah.
It's just crazy. And then I saw some article of people going around and interviewing, customers at Woolworths and Coles that are loading up their trolleys full of toilet paper, and they're just asking them, why are you buying all this toilet paper? And a lot of them didn't even know. They didn't even know why they were buying it. They were just like, oh yeah, I heard that we should probably stock up. It's just like,
yeah.
It's crazy. It's kind of like the same thing you apply it to the share market. It's just like, why are you selling your stocks right now that the share market's going down? I don't know. I just heard that the stock market might crash.
Why do you have 10 Bitcoin? I just heard it was doing really well, so I didn't want to miss out.
It was going up, so I bought it. I mean, my best mate, he made like $1,000 in a day.
It's true. It's just fear and greed, or it's just the
fear, uncertainty, and doubt.
Yeah, it is. It's
FUD.
It's yeah.
And now that I've said that, it's going to be like the coronavirus will turn into the biggest virus the world has ever seen. It's just like, oh god damn. Brandon said it wouldn't happen. Anyway, pretty crazy.
Yeah, one thing one thing I saw was on Amazon. A few Amazon sellers have kind of taken the opportunity to just price gouge things like hand sanitizer and face masks. I saw some hand sanitizer on there for $2,000 a bottle.
Holy moly.
Yeah. They changed the title as well to limited edition. And it was just...
Oh, that's hilarious.
So,
coronavirus edition.
Yeah, exactly. And
there are a few scam-trepreneurs.
Yeah.
Hitting, like I've heard that people are selling toilet paper on Gumtree now.
Wow. Yeah.
At a markup. Yeah. Just price gouging like crazy. I don't know. Is that stuff, are you allowed to do that? I don't know.
Yeah. I mean, there are laws in some industries like pharmaceuticals where there's sort of caps on how much you can increase prices. But right. I don't think there's anything wrong with, I mean, if there's just an increased demand, which really is what is happening. There's just
what's happening.
There's an unnecessary increased demand for toilet paper. I don't think there's anything particularly legally wrong with buying a bunch of it and selling it for a really high price.
Right.
I think it's a little bit scummy, a little bit immoral, but
oh yeah,
but
it's like ticket scalping.
Yeah,
stuff
true.
like that.
When you just,
it's just like you step back and you look at the business model of it or whatever, and you're like, oh, that makes a lot of sense. And then you look at what they're actually doing, and you're like, holy moly, you're a bad human being if you're doing that.
Yeah.
But yeah, I just thought it'd suck if you like got diarrhea right now. Imagine if you got diarrhea and you're like out of toilet paper. That would suck.
Oh no.
Imagine if you couldn't go and buy more toilet paper.
Yeah.
Paper towel, that'll do.
$10 a sheet off Amazon.
Yeah, $10 a sheet. Oh my god. It's like one ply. It's like the worst. It's like using paper.
Yeah, you have to start separating it. Have to ration it.
Anyway, I think that's enough about flipping coronavirus. Actually, let's talk about one news story related to it while we're on the topic. This is not so much about the disease or the craziness that's going on. I guess it is in a way. I saw a report coming, or a news article coming out saying that United Airlines is going to start cutting service on domestic routes, so within the United States, which is pretty interesting. So they said here, the article says United Airlines signaled on Wednesday that fear over the coronavirus epidemic was eroding ticket sales not only on international routes, but also on domestic travel as well. The carrier said it planned to cut international service by about 20% and domestic service by about 10% in April.
Wow.
And that it was weighing up similar cuts in May. So it's pretty interesting that, I think one of the questions we've got in Q&A today is like, what sort of companies or industries or whatever should we be thinking about, maybe potentially exploring or taking advantage of or learning more about based on all of this fear of coronavirus? Well, I think that this is an interesting example. Obviously, things to do with tourism, air travel, especially
business travel.
Those are the ones that they may not be impacted in the long term, but in the short term, they will definitely be quite heavily impacted. I was looking at some of the airline stocks just because I had this thought this morning. I was like, okay, I wonder how much the airline stocks actually have gone down based on coronavirus. So we've got, out of the US airline stocks, there's Southwest, and that's down 20% in just a couple of months. American Airlines down 40% in a couple of months. United's now down 33%. Delta's down 21%. And then even here in Australia, Virgin Australia's down 30%, and Qantas is also down 30%. So, I mean, this is one of those, I guess, examples of those short-term industry events or short-term market events that could potentially, if you knew what you were talking about when it came to stocks to do with, the airline stocks, you could potentially be seeing some, businesses come down to what you'd consider a margin of safety price if you didn't think that they were going to be impacted in the long term.
Yeah, well, I'm glad you brought this example up because many of you would be aware that Warren Buffett has stakes in all of the American airlines, the top 4 American airlines.
Yeah, all the ones I mentioned.
Yeah, and earlier in the week, there was a report that came out that Buffett bought about 1 million shares of Delta last week.
Really?
So
okay.
He holds 70 million shares, to be clear. So it's a small addition.
It's a small... The Warren Buffett's positions in the airlines is like 0.5% to 1% of his portfolio for each stock.
Yeah. And I believe of Delta, he now owns about 13% of that company.
Right.
So he was adding a little bit, but obviously he wasn't able to add enough. Adding 1 million shares to your 70 million that you have of a position that itself is, what did you just say, maybe 1% of his overall portfolio is it's a fraction of your portfolio that he's adding. But he obviously thought that the stock was at a better price last week than it was previously as a result of this. And I mean, it's really going to be travel related companies that are going to get hurt the most, I think, during this period. One of the travel-related companies I was looking at. Did you have anything else to talk about for United Airlines?
Oh no, that's all I just wanted to say. Is just it was just an example of an industry that's going to be heavily impacted by coronavirus, but may not be in the long term. Yeah,
well, a slightly related company, still in the travel industry, but leaning more on corporate travel, is Corporate Travel Management. It's an Australian company that I've been looking into recently, and their stock has been severely hurt by the coronavirus, but also one of their major short sellers, which has delightfully released a new report. So just to give a bit of context, there's an investment fund in Australia called VGI, and they've publicly had a big short position in corporate travel management for about a year. And essentially last year when they opened their position, they released a report, and in that report they just outlined maybe 10 different sort of claims that they made. Some were relating to accounting, about numbers that didn't add up, or questioning their high margins compared to the industry average, questioning whether that was even possible. And right after that sort of happened, the stock was down as much as 46%. So
really?
Yeah, so they did quite a good job of making that report, making investors believe that report, I guess, even though Corporate Travel Management came out and they pushed back against all of the claims that were made.
Oh my gosh.
So it was hurt quite badly after that, which I'm sure VGI was very happy about. And then basically what happened was the next report came out, the next annual report for corporate travel management came out, and their results were amazing again. So the stock started to recover a little bit, almost back to its highs, but not quite. It was still down a fair bit. But interestingly enough, as it was recovering, VGI reported that they started to lose money on that short position for the first time. And then conveniently, 2 weeks later, after they released that, they released a new report, which came out last week.
I see.
And now the stock is down 63% from its peak. So they've sat in their boardroom and gone, okay, what happened last time? We released the report, stock went down, we made money. Then we waited, stock went up, we lost money. We need to do another report. So they did another report that came out. And this one, corporate travel management, was having none of it. They were furious about this one. So they actually hired an independent auditor to look at all of the claims and found that they were all completely false or misleading.
That's hilarious.
And the management's actually considering suing VGI for stock manipulation,
fair enough.
as well as taking advantage of the coronavirus, which was already affecting the business. Management had come out and said this year's results are going to be substantially hurt because they do a lot of business in Asia for organizing corporate travel needs, planes and accommodation and that sort of thing. So, it's interesting to see this because they've made a lot of claims about corporate travel management and they've done very well on their short position because of it. But will this have a long-term effect on the business, and are any of their claims true? It's we don't really know, I guess, at this point.
I'm just trying to look up what the opposite of the pump and dump scheme is. It's got a name, but I can't for the life of me remember what it is, because it sounds like, because that's illegal in the same way that pump and dump is illegal. I can't remember what the opposite is. The short seller version, where you just make up a whole lot of fake news to try and get the stock price to go down so that your short position does well. That's also illegal. So maybe they could, they might have a good chance at getting back at VGI if what they say, it sounds like VGI are just making up a whole lot of crap.
Yeah, I mean, I'm obviously not an expert in this stuff, but I read through it and it seemed as though a lot of the answers that corporate travel management was giving seemed very, very reasonable. A lot of the claims were just very misleading in the way that they were written. It wasn't as if they were false. It was just them saying, like, for example, VGI would say, they included this measure in the presentation to mislead investors into thinking they were doing better than they weren't. And then corporate travel management would just come back and be like, we included that to provide greater context and how this relates to this and that and this. And it was just a little bit of he said, she said, nothing that was true, like they're committing fraud or anything like that. It wasn't as if they were claiming that they were breaking the law in any major way.
I remembered what it was called too.
What was it called?
Short and distort.
Short and distort.
There's pump and dump and short and distort.
I like it.
I forgot.
That's interesting.
I'm glad it came back to me now. I was on the tip of my tongue. I just couldn't remember. Yeah. But, I guess like that will probably be an interesting story to follow to see what happens there.
Yeah.
Because you're right. Just looking at the stock price of corporate travel management, it's been destroyed.
Yeah.
It's down so much.
Yeah.
Maybe it's time to start looking into these guys properly.
Yeah, I mean, it's been one
you've been looking into them, haven't you?
I have, and I have a small position in them as well, which I recently made, but I'm not quite ready. I think I'd like to see it go down a little bit more if it would. But
okay.
We're talking about a company with 10 to 15% growth over a 10-year period, down 63%. So how much further is that going to go? I don't know, because that's pretty horrific. I've seen companies that have negative growth or maybe 5% growth that go down that much, but a company that has double-digit growth and nothing the coronavirus is something that's affecting it in the short term, obviously, as well. But I'll be certainly watching it, and we'll have to wait and see.
We'll have to wait and see. PE of 17, 3.2% dividend yield. That's not too bad. No, we'll follow that one.
We will.
I'll put that tab to follow. All right, let's move right along, and we'll talk a little politics. Although we're not super knowledgeable about politics, so we won't talk too much. The one thing I found interesting though, with what's going on, what do they call it? Democratic primaries?
Yeah.
Bloomberg's now dropped out. But here, I
He's
just saw
out.
this as, a bit of it, just some interesting statistics, because obviously Bloomberg is the billionaire. He seems like a nice guy, but I haven't really researched him too much. He spent 500 million of his own dollars on his campaign, which is pretty expensive. Like, that's a lot of money. Yeah. But the crazy thing is, when you break it down per day to a per day statistic, he spent $5.4 million a day on his campaign. Imagine having that sort of cash.
Yeah,
man.
Man, it would have been hilarious seeing Trump, one billionaire, versus Bloomberg, another billionaire, and Bloomberg just chucks like $5 billion into ad spend or something, just something insane. Because I remember, I think Clive Palmer was our sort of big spender during our election.
That's what I was going to say.
What did he spend? Maybe 30 million or something like that.
Something like. Well, I think it might have been higher. It might have even been like 60 million.
Maybe
or
like
something.
60 million. But either way, a fraction of what Bloomberg has spent just in the primaries. Not even in a general election. So. That's hilarious.
yeah, it's crazy. It does seem like now it's going to be Sanders versus Biden.
Yeah, it does.
I don't know. I really like just Elizabeth Warren as a person. Like, she's just such a nice person, but I just don't think that she'll compete with Biden or Sanders. Who do you reckon, if it was Sanders or Biden, who do you reckon's got it?
I honestly don't know.
I don't know
I'd
either.
Probably. Just because of how much support the core of the Democratic Party is going to get behind Biden and try and not get Sanders in, I think that Biden probably has a better chance. But yeah, I don't know. Either way, it's going to be hilarious watching Trump in the general election, because his debates are just so funny. It's like a sport. We in Australia, for those who are overseas, we don't have any debates. We had one or two debates.
Oh, we had a couple of debates. Like a couple, but they're pretty piss poor.
Yeah, exactly. There's no real back and forth. In the US, it's absolutely hilarious. I find it so funny.
Yeah, it's like entertainment.
Yeah, Trump's just out there just throwing fists at people.
Yeah, he's crazy. Did you see the video of him asking whether they could use the flu vaccine on the coronavirus? Did you see that? No, it's hilarious. He's basically like, so do you think you could take just like a flu vaccine, and do you think that'd, if we mass produce that, would it have a big impact on coronavirus? Would it have a big impact on corona? And then whoever, I think it must be a medical professional sitting there, and he's just like, look, no. In fact, probably no effect whatsoever. And then Trump just kind of like nods and is kind of like, oh yeah. It's like, And did you see the photo of the coronavirus task force led by Mike Pence sitting around the table praying? Did you see that?
No,
did you see that?
I did not see
that.
Like,
I'm totally cool. Like, I got nothing against religion, and if you're religious, like, that's all good if it makes you happy and that sort of stuff. But you can't pray for a medical condition to go away. Like, I draw the line there. You cannot pray for a flu or a coronavirus. You can't pray that away. Oh, that just, and it's infuriated so many people online just seeing that photo. Just like, we'll just hopes and prayers it. Come on, guys, let's all hopes and prayers it.
Might work, maybe.
It might work. Yeah, you never know. Look, the coronavirus, it's going away. It must have been our hopes and prayers, but no, seriously, man. Gosh, this stuff frustrates me sometimes.
Brandon,
anyway,
relax, okay? It's early in the morning, all right? You can't be this angry this early.
The thing that really irks me is when people try and argue against irrefutable evidence or irrefutable science, the same way that we've been talking about climate change for the last couple of decades now. And there are still people that are saying, no, we don't believe in the science. It's like, you can't not believe in the science. That's the thing about science. Science is true whether you believe it or not. It's like, that's the whole point. The objective of science is to find out what is objectively truthful. All right, calm down.
Rant over.
Breathe, go to your happy place. the stock market's crashing. The stock market's crashing. Companies are coming on sale. There are deals everywhere. Oh,
Hey,
that's better. That feels better.
Here's something you'll like. The Royal Mint has unveiled a new gold coin as part of its new James Bond collection.
I do like James Bond.
Yeah.
Are you a Bond fan? Do you like the James Bond movies?
Yeah, I do. I'm not someone who obsesses over it, and I haven't seen any of the recent ones. But I like a few of the older ones. Casino Royale is probably my favorite one.
Oh, Casino Royale. Geez, they hit the nail on the head with that movie.
That's a good one.
Oh, that's a good one.
Yeah.
I love that. Mads Mikkelsen playing Le Chiffre. Oh, so good. So good.
Yeah.
Man. They need to incorporate more poker back into James Bond.
I think that's what it is. I think I really like poker movies or poker related movies because they're always, because real life poker is almost never like that. So it's always so fascinating. It's like, oh, it's 1v1 and this guy's got this guy. I don't know. They always make it so entertaining.
They're like chucking down millions of dollars.
Exactly.
It's cool. I like
$10 million.
I like kind of casino movies.
Yeah.
There's a couple out there that are good. What's that one called that's all about counting cards? The guys that go and clean up at Vegas counting cards.
What is that called?
I can't remember.
Who's the actor in that as well? It's Kevin Spacey and someone else. Gee, what is that called?
Counting cards movie. Is it 21?
That's what it is. Yeah, 21.
Derp. Of course, it's called 21.
Yeah. Yeah, that's a good one.
Dear.
I watched that recently, actually, for the first time. So
I saw it not too long ago. Yeah, 21. Yeah, yeah, that's a good movie. I'm gonna go watch that later. Anyway, back to this actual news story. So what was it? The Royal Mint, they've unveiled a new gold coin as part of its James Bond collection. It's a one-of-a-kind collector's item. The 7-kilo gold coin. This is not like a coin.
Oh.
This is not like something you trade for groceries or anything. This is like a collector's item. The 7-kilo gold coin has a face value of £7,000, which is about 13,500 Australian dollars. Features an engraving of an Aston Martin DB5 with the famous BMT 216A license plate surrounded by a gun barrel. There is no word yet on what the coin could retail at, but people interested are being directed to call the mint to discuss. So here's the collection also includes a smaller 2-kilo gold coin with a denomination of £2,000 and has a recommended retail price of £130,000, which is 253,000 Australian dollars.
Whoa,
man. Jeez, it's kind of weird in a way. Like, I get that it's a collector's, like, I understand how it works, but it's still kind of weird that currency that's worth, like, in general use, worth a certain amount can be sold for just an incredibly higher amount just because it's a collector's item. Like, the fact that it's legit, like, legal tender doesn't matter anymore in terms of its price just because it's a collector's item. It's kind of funny.
It's fascinating. Were you ever into coins? Is that something you ever did, collect coins?
I do. I always like getting a shiny new coin out of the Woolies change machine, but I've never collected coins.
Yeah, fair enough.
It would have been something I would have liked to collect, but yes. Did you collect coins, or was I talking to someone else?
No, it might have been me. A lot of people do it, Brandon, so it could have been. No, I'm kidding.
That's true.
I used to. I had a 50 cent, I think I still have it, a 50 cent Australian coin collection. And I had a book and I was going through and getting all of them. I think the first one was 1961 or something like that. So
wow, okay.
Yeah, that was fun.
You probably hold on to that and that'll probably be worth a fair bit, when you're 80 or something.
Here's a fun fact. The first 50 cent coin was made of silver, so it was worth quite a lot more than 50 cents.
Than 50 cents.
And it was round. It was not, what is it now, an octagon? No, a hexagon.
I
think it's a hexagon.
Octagon.
It is an octagon.
Octagon, yeah.
Yeah, so
there you go. I'm going to look that up. A circular 50 cent coin.
That's it.
50 cent coin.
Yeah.
Made of silver.
I gave up.
On sale. eBay. Let's have a look. How much is it going for?
How much?
Wow.
How much?
19. Oh, no, sorry. It's about $14. I saw it was like a pack of 5 for $52. So I thought that one coin, I didn't see that it was a pack of 5.
Okay, yeah.
Wow, that looks so strange. Seeing
strange.
because it's the same design on the
Yeah.
front for the 50-cent coin, but it's just round.
Yeah.
Instead of the octagon.
Yeah. So,
Wow,
so that
that's
was
crazy.
fun.
There
Yeah.
you go. Do you have one of those?
I do. Yeah. I think I have 2 of them
Oh,
actually.
nice.
So,
Well, there you go. You're $13 richer.
Yeah. Well, I probably
good investment.
I probably paid more than that for it. So I mean,
really?
I didn't find it, so
Oh, okay.
I had to buy
right,
that one.
Right.
Yeah.
Yeah, imagine if you found one of those in circulation. That'd be ridiculous.
What the hell is this?
1966. Yeah.
1966.
Yeah.
That's it. Yeah.
Although I think the Mint has a program where they take old coins out of circulation, don't they?
Yeah, I'm sure they do. I think that's where I picked up that round coin was there. I think they were selling them.
Okay.
So, yeah.
Right, okay. Should we... So, yeah, that's pretty crazy. A very expensive coin there. Should we get along into some Q&A? I don't really want to talk about Jeans West.
No.
That's a boring story. Basically, Jeans West was going bankrupt. They went into voluntary administration, and then some Hong Kong company got them out of bankruptcy and bought them. So,
What a
yay!
story.
Jeans West fights another day. All right, moving on.
Yeah, we should do some Q&A because we didn't do any last
sure.
week, so we should do a couple. Let's
Yeah.
see
So
what we
let's do I'm new to investing and I'm looking for some tips to get started. So if you had someone, maybe it was one of your friends, walked up to you and just said, look, I'm looking to get started in the stock market. I don't know anything about stocks or financial markets or anything. What do you have, like a kind of go-to kind of set of tips that you would give someone?
a go-to not financial advice.
Not financial advice. Yeah, buy this stock.
No, but yeah.
All in on Tesla.
I think what I just tell people sort of what I did when I got started, and I think this is probably a good approach for a lot of people, is that I just started with index funds because that way you don't have to worry about an active fund manager or picking the wrong active fund manager who's going to make the wrong mistakes managing your money, and you're getting a broad diversification. And really the sort of go-to method when it comes to index funds is just to consistently contribute to that. So figure out how much you can save out of your income, a percentage amount, and set it aside every single month, and then maybe every 3 or 6 months add more to that position. And the other thing I would mention is just that if you have any credit card debt, any high interest debt, you want to pay that off first because you will almost always make a better return just by eliminating the interest payment on that debt than you would in the stock market.
Because some credit cards are now, they've got 13, 15, 20% interest rates on them.
Yes. Yeah, I think I had a credit card for a while. I wasn't using it to rack up debt, but I just used it to sort of gain credit. But I think it had 28% interest or something.
28?
Yeah. And
holy smokes. See, I've never used a credit card, so I don't really know too much about them.
And they really get you because a lot of them, they compound the interest daily. So 28% is kind of misleading. 28% is the yearly return, is the yearly interest.
Yeah.
But they're calculating it on a day-to-day basis as a fraction of that, which makes it much higher.
So over a year, that will cost you more.
Much higher, yeah.
Yeah. No, I'd agree with that. I think the dollar cost average, or buying like an ETF as your first investment, is probably, like, obviously not financial advice, but it's probably not too bad of a strategy, just because as a beginner, like you haven't got any experience. So it's a very widely diversified investment. So it means that if it's going to go down a lot, that will mean that, everything, like the whole market is going down. And obviously it's much harder for the whole market to drop substantially, like 50, 60, 70% than what like an individual company. So it kind of protects you a little bit like that. It's a good diversified way to get some money into the market and still kind of get a feel for what it feels like being in the market, because obviously that's something you can't be prepared for, the emotions that you feel when you've got your own money on the line. But the other thing, that the reason that I also tell people that are new to investing that the way I started was with an ETF or listed investment company, is just because even if coronavirus grips the whole world, and over the next few years we see horrible stock market conditions, and it just tanks horribly. If you just held your shares and you just held them right the way until you're getting ready to retire, so you literally hold them for like 40 years, then you'll look back in time and whatever happens in the next 2 or 3 years will look like just such a small, tiniest little blip on the radar, like a fly on the windscreen, that it really won't matter. So that's why I think it's kind of an interesting thing to research for new investors, is because if worse comes to worse, you just hold it.
Yeah.
Just hold it for a very long time. Just come back in 40 years.
Yeah, I think that's really important to talk about as well, is that when you're investing in the market, you need to be comfortable letting that money go for at least 5 years. I would even often say 10 years. 10, You need to accept that it might be down over the next 5 years. It might be down over the next 2 years. So you need to be only putting money in there that you're willing to not take out. And I know, I'm sure you get this as well, but I get people sort of sending me messages saying, how can I sort of get started? Some of my friends and stuff. And I know a few of my friends who sold all of their index funds last week. And that's a big no-no in the dollar cost average strategy, because they might even be an opportunity to pick up some more. Or if you're just dollar cost averaging, you just don't do anything. You just keep following your plan. You just keep investing every 3-6 months. And pulling out is definitely a bad idea, because it might go down further, but it might go up from here. And then how long do you wait before you get back in? And it's often that straight after a drop is sort of where the best upward movement is experienced. I mean, for example, we had 2 days this week where the US market was either 3 or 4% up. I think last night for the US, for the Dow, was 5% or something insane.
Wow.
And you really can't miss out on those days. Those days are what make your portfolio go up over the long term. So
I think that's probably something I've learned with more experience. I'm not going to lie and say that I'm super experienced in the stock market, being a 25-year-old. But one thing that I've kind of learned, or one thing that I do now, is I buy and I sell much less than what I used to when I was just starting out.
Yeah, me too.
I feel like when I first started out, I knew that I should hold my shares for a long time, but I hadn't fully committed to the idea of being a decade or multiple decade long investor.
Yeah.
Like, for instance, I genuinely don't know the answer to this, so I'd be interested to see if this lines up with what I'm thinking. In the last 2 or 3 weeks, have you sold any stocks at all?
No. None at all.
Me neither.
Yeah.
Me neither. Have you bought any?
Yes, I have.
Yeah.
Yeah.
Yeah. So same with me. I've bought stocks, but I haven't sold.
Yeah.
So there you go.
Yeah. And I remember my first year, it would be a long time for me to hold a stock for 3 months, for example.
Yeah, exactly.
I'd hold it and be like, it's up 20%. Wow. Is it overvalued now? It must be. And then I just sell it. And now,
or even me, when I started out, I'd be like, I'm up like 2% now. Sell. I got to claim my $15 or something like that.
Yeah.
I got to realize that gain.
Yeah.
It's just silly.
Yeah, I think I stepped back a lot. Like when I was getting started, I was very much following the market every day. I was looking at stock price charts and all of this stuff. And now I'm very much, I've taken a big step back from that sort of daily stuff. I don't watch as much news. Yep. I don't read as much news. If there's something going on with a business that I'm looking into or I hold, I'll know about it, because it has to be substantial enough that it's going to move the stock 20 or 30% for me to be interested anyway. So that's not going to, I'm not going to miss that. For like the Facebook stuff that went on for like 8 months, for example, all of the negative stuff coming out about Facebook. There's no way I could have missed that just because I didn't read the news one day. So I've kind of learned to step back a little bit, let things happen, and realize that the opportunities to invest are a lot less frequent than, and you can't force them to appear by just studying every single day, or like looking at charts every single day, I should say.
Yeah. The only reason I'm looking more at charts now is just because they're going down. I just want to keep a track of what companies are going down a lot. But yeah, when the conditions are normal or bullish, I barely check stock prices, because you're right. You know, if something happens, you'll hear about it. Okay, we've got a bit of a backlog of questions to get through. I think that we could probably tick this one off the list. Another question we had from one of you guys was, what are your thoughts on dollar cost averaging? I think that we actually covered that pretty well, just answering that last question. I think we're both pretty big fans of it, particularly if you're someone that doesn't want to spend your hours, studying individual businesses and you just kind of want the set and forget kind of approach. I think that's the best way to do it. But I think it's the only good way to go if you're strict about it, if you actually follow it properly. Because a lot of people say, oh yeah, I'm big into dollar cost averaging, and then they're just like buying and selling and doing all sorts of other crap. They're not actually dollar cost averaging. It's like, wait, didn't you tell me you were dollar cost averaging? Yeah, but it's like, no, well, hang on.
But I'm just going to sell out now and wait for the coronavirus to go, and then I'm going to buy back.
And then it's like, no, dollar cost averaging, is a strict strategy where you're just a buyer at consistent intervals, and that's what makes it such a good set and forget kind of strategy. That's what makes it work, is that you get the market return because you show up every 6 months or every quarter and you invest the same amount in the same market diversified investment. You just keep going. But yeah, that's probably the biggest thing. I'd say if you're interested in dollar cost averaging, just make sure you actually dollar cost average.
Just don't think.
I think it's easy on paper, but it's hard in practice.
It is.
Yeah.
Definitely.
Yeah. Here's another question. Are there any good newsletters or magazines or, just any resources that you find yourself checking or following regularly?
That's a good question. I guess kind of related to what I said before, I don't really follow much news that much anymore.
Nah.
I have like Google Finance alerts on my phone, and then like a news article, a couple of major news articles for the stocks that I'm following will come up as notifications. But most of the time, I just swipe them off, unless it says something like Facebook stock is down 20% in a day. Then I'm going to click on that and I'm going to see what's going on. But I don't really follow anything. Resources wise, I'm mostly looking for. I use, I guess, websites that provide financial data to help me analyze businesses, like quickfs.net. That's quickfs.net. It's a free website that I use to get financial data. But yeah, what about you? Do you have any?
Look, I'm a big fan of Sharesight.
Sharesight. True. Sharesight is awesome.
No, like full disclosure, I haven't started using Sharesight yet. But I don't read. I don't read.
I can't read. Reading? No.
It's not for me. I don't follow any magazines. I was talking to Jason Hughes from Business as Usual the other day, and he was saying that one that he's been reading recently has been The Economist, and that's kind of a good one for beginners. It's kind of in plain language, which is helpful, but he's finding that that definitely helps you keep up to speed with everything that's going on. But I mean, a lot of the time I just kind of cover the news stories just by researching what we're going to talk about in this podcast, just like on news sites.
Yeah.
And yeah, I guess like for me, I guess we're kind of like weird examples, because if there's something that's going down, I'm going to hear about it like in the YouTube comments kind of thing, as well. Like if something happens to one of the stocks I'm talking about, it's 5-10 people are going to comment, hey, did you see this? So that kind of makes it easier in a way for us to kind of keep on top of this different news.
Yeah.
But no, I don't think there's anything that I don't subscribe to anything or anything like that.
Yeah.
But I was thinking about giving The Economist a try just based on Jason's recommendation. But
yeah,
I don't know.
Could be
anyway,
good.
Should we move on to the next one?
Yeah.
Have we got any? Should we do one more? Or I don't know.
Yeah, I think we should do one more. Yeah.
Okay.
Here's one. So, hey guys, long-time listener from Australia. Hello. Could you give your thoughts on Raise and how it compares to other Australian investment tools? Do you use Raise, or have you used it in the past? Or
I think I'm just too hands-on with my investing for something like Raise to be particularly useful for me. Like, I'm a big fan of the whole idea of what these apps do. I mean, they're just trying to make it as easy as possible for people to get into investing and get consistent with investing, because as I understand it, it's mostly just passive investing through these apps. which for most people is going to be the way they want to go anyway. But I like the idea, and I don't know if Rays still do it, where they kind of, if you buy a coffee, they'll like round it up and take that rounded up amount, put it into your investment account. I liked that feature because it kind of gets people just slowly contributing without really noticing. I like them. I think that they're good. I think that they fill a need. Some people have said to me in the past that you just got to be careful of the rates that they can charge sometimes. I think the ones in Australia, there's Spaceship Voyager and there's Rays. And are there any other ones?
I'm not sure. I think Rays used to be Acorns.
Acorns,
right?
Yeah, that's Acorns.
Yeah.
But like generally I'm a fan. I can't say that I've used them just because they don't really fit my need. But I don't know. What do you think?
Yeah, I remember downloading it when it was Acorns a long time ago and just having a look at it. And yeah, I think as you mentioned, I like the feature where it kind of rounds up your purchases on your card, and just invests the difference. I like that to sort of get people in the mindset of just contributing a little bit regularly. But yeah, you've got to be careful of fees for these kind of apps. They're certainly taking their cut in order to invest your money. And a lot of the time they're investing your money in index funds or ETFs, like maybe a few different ETFs to kind of build a portfolio. So it's certainly something you can do on your own. But I think for people who are complete beginners and have no idea what they're doing and they just want to get into the mindset of starting to build some wealth, then they're probably a good place to start.
Yeah. Yeah, so they've got, for Rays, I'm just looking at, they've got 6 diversified portfolios. They've got like a conservative, moderate, conservative, moderately aggressive, and emerald. But yeah, it's just a collection of ETFs for each portfolio. And I think they just weight the ETFs differently based on what portfolio you're buying into.
Yeah.
Oh, I mean, it fills a need.
It does,
so,
yeah.
I mean, give it a go. And if you don't like it, then you don't have to keep using it. Or if you want to get more hands-on with your own investing, then there's no reason why you can't do that.
Definitely.
But yeah, I think that'll be just about it for today. We do have a bit of a backlog of questions, so we'll try and get to more questions next week, maybe. But as always, like if you want to submit a question for us to discuss on the podcast, then go to the YouTube version of this podcast. So I hope everyone knows now that we've got our own YouTube channel specifically for the podcast. So you just type in the Young Investors podcast into YouTube and it should come up. And then just go to the most recent podcast episode and just leave a comment if you have a question. So we've got a couple of questions already, as I was saying, from previous podcasts that we just didn't have enough time to get to. So we'll make sure we get to those next week. But yeah, other than that, podcast is available, of course, on Spotify and Apple Podcasts as per usual. And make sure you do check out Sharesight. Thanks very much, Sharesight. Spite you. Sharesight for sponsoring.
Yes, head over to sharesight.com/young investors. And that is, the site in Sharesight is spelt SIGHT. If you're trying to look it up and you're listening here. But
and we appreciate if you do check it out as well, because it helps support what we're doing, obviously, with the podcast, because we don't make money off this podcast. So our goal is to make the podcast break even. So we appreciate any support. But that'll do us for today, guys. Thanks for listening, and we'll see you guys next week.
See you later, guys.